good evening to everyone. I hope you all are fine and doing well. Today's session is all about the risk regulation in banking industry. It is impossible to cover all the important terms in just a half hour of time. So what I do here, I included some questions which are related to this chapter and the most important questions, and with the help of these questions we will learn the concepts behind these questions. So we will discuss every question and the concepts behind these questions, and I hope that everything is fine from my side, my audio, my video, and my screen is everything is okay. So let's start with the class, with the today's class, risk regulations and uh, risk regulations in the banking industry. Okay. Let's start. Radhe Radhe ma'am, Radhe Radhe. So let's start with the class, and here is the first question. As you can see here, systemic risk is the risk of. So you have to tell me the risk, systemic risk. What is the meaning of systemic risk here? Okay. If I tell you about the systemic risk, what is the systemic risk? That is the risk which refers to the breakdown of an entire system. Breakdown of an entire system rather than simply the failure of individual parts. We can say here some of the things that outlines the example of external events that represents the sources of systemic risk, like global recessions, geopolitical risk, global pandemics, natural disasters, and some type of monetary policies like inflation, currency crashes. So these are some things that outlines the example of the external events that represent the sources of systemic risk. And in this we can say which option is correct. Systemic risk is the failure of the entire system. So we can say here option D is correct here. No issues. Focus on English, that it's not a very hard task. Okay, you can also learn English fluently. So this is all about systemic risk. Whenever it is talking about the systemic risk, that means the failure of the entire banking system. Okay, now second question is here. Just a minute. Central bank governors of the G10 countries that participate in the Basel Committee on Banking Supervision. So how many members are there? So if I talk about the first Basel Committee on Banking Supervision, as we know that what is the meaning of Basel Committee on Banking Supervision, that is BCBS, it is an international organization. It is an international organization basically that sets the standards for the banking supervision. That sets the standards for the banking supervisions and the regulation at global level. This Basel Committee comprises 45 members from the 28 jurisdictions here, yeah, this is the correct spelling, which consist central banks and the authorities with formal responsibility for the supervision of banking business. And this G10 is made up of 11 industrialized nations that includes central banks from the Germany, Sweden, as well as the government from the Belgium, Canada, France, Italy, Japan, Netherlands, Switzerland, United Kingdom, and United States. So this G10 was established in the 1962 just to lend the money to the International Monetary Fund, and this G10 members meet regularly to discuss, to debate, and to cooperate on the international finance. So which is the correct answer here? We can say option B is correct here. Okay. Next question here. 1988 Capital Accord framework is accounted for. Just try to focus on all the options, then I will tell you the correct answer here. Just a minute. Okay. See, if I talk about the 1998 Basel Accord, which is also known as here, this 1988 Basel Capital Accord is also known as Basel I. And this is one of the earliest of the three Basel Accords, and it introduced the capital reserve requirements for the banks, which are based on the riskiness of their assets. So here what we can say, this capital accord framework accounted for the credit risk, means in which the borrower is failed to pay the obligations, to meet the obligation, when the borrower is unable to pay the principal amount and also the interest amount. That is the credit risk. Market risk, when there is a risk in the bank due to the changes in the market factors, that is market risk. Operational risk is completely related to the internal errors of the bank. And defined capital here is basically, this is type of a component, which is basically specific to the amount of capital that a financial institution is required to hold a cushion against the potential losses. And this requirement is typically mandated by regulatory bodies to ensure the stability and the solvency of the financial system. Okay, so this 1988 Capital Accord framework is accounted for the credit risk, market risk, and the defined capital component. So correct answer is here 1, 2 and 4. That means our option 2 is correct here. A second option we can say is correct here. Okay. Third question. Back testing is done with. Back testing is done to. See, what is back testing? It is a process which is used to evaluate the historical performances of a trading model or strategy by applying it to the past data and comparing the simulated results to the actual outcomes. This helps in assessing the model's effectiveness and identify the potential shortcomings before deploying it into the real world trading. And this is a vital technique which is used in financial modeling to evaluate the historical performance of a trading strategy, model or system. And by applying the model to past data and comparing the simulated results to the actual outcomes, analysts can assess its effectiveness and identify the potential flaws before the deployment. So this back testing is done to compare the model results and the actual performance. Okay, clear the concept of this question? Then under Basel II, capital requirement under accord is under Basel II, capital requirement is just determined by the regulatory authority that is based on the bank's risk profile. This means the amount of capital a bank needs to hold is not fixed but varies depending on its specific risk. And when there are caps and floors in place to ensure that capital requirements are reasonable, the ultimate decision on the amount of capital required rests with the regulatory authority. And Basel II, this is a set of international standards which governs the bank capital adequacy, market discipline, and also the business practices. And it was developed by the Basel Committee on Banking Supervision, a committee of central bank governors and the banking supervisors from the major economies. So we can say that under Basel II, capital requirement under the accord is the capital as it is specified by the regulatory authority and it is required to be maintained. Clear? And now capital charge for the credit risk requires input for the PD, LGD, EAD, M, and under advanced IRB approach, who provides the input for the LGD? See, if I talk about the advanced IRB approach, here banks are allowed to use their own banks. So we can say use their own internal models to calculate the capital requirements for the credit risk, and this includes the input for the loss given default, that is LGD. Banks are responsible here for developing and validating their own LGD models which are subjected to the regulatory oversight. And while this BCBS provides guidelines and also the framework for the advanced IRB approach. It does not directly provide the input for the LGD. It is up to the individual banks to develop their own models which are based on the specific requirements and circumstances in the data, and these PD, LGD, EAD and M, these are the four key components which are used in calculating the credit risk under the Basel II and Basel III frameworks, and they are also used to determine the capital requirements that bank must hold to clear the banks and to cover the losses from loans and other credit exposures. So we can say here is the correct answer is bank. Bank provides the input for the LGD. Clear? Then, under the standardized approach, the rating assigned by the eligible external credit rating agencies will largely support the measure of obviously credit risk. Under the standardized approach, the rating assigned by the eligible external credit rating agencies will be largely support the measure of credit risk. This standardized approach is a very simpler method for calculating the capital requirements under Basel II, and it requires pre-assigned risk weight based on the credit quality of the exposures as determined by the external credit rating agencies. So these external rating agencies can also be used to assess other risk like market risk and the operational risk. They are primarily used for the credit risk under the standardized approach. So we can say the correct answer is here credit risk. Clear? Then yes, under the RBI third norms, the DCF banks here will be plotted into dash different buckets and would be required to have additional common equity tier 1 capital requirements. See, if I talk about the RBI Basel III norms, they are DCF means domestic systematically important banks that are categorized into 5 different buckets based on the systemic importance, and each bucket corresponds to a different level of common equity tier 1 capital requirement. The higher the bucket, the greater the additional capital requirement, and this system is designed to ensure that larger, more complex banks hold a sufficient amount of capital to absorb the potential losses and maintains the financial stability. So we can say here option A is correct here. Okay. So these are some questions on this chapter, and I just like I'm not lying that this chapter is a little big chapter and one of the important chapter in module B, and these are some questions which are very important, and I hope that these questions will help you in understanding some concepts of this chapter. So that is it from my side for today. I hope that everything is understandable to you. If anywhere you feel any problem, you can do the comment. I will address your query. So thank you so much. We will meet in our next chapter, for our next chapter at the same time. So till then, take care everyone. Thank you everyone, and take care all.